Hello and welcome to the Prescribing Prosperity podcast with your hosts, John and Alex Soutsos. Gentlemen, good to be with you again. How are you?
Excellent, Bill. Thank you.
Nice to see you again, Bill.
Nice to see you as well. So, we teased this topic in our last episode, financial planning for young adults, but I think I have a pretty good idea of what that means, Alex, but why don't you lay it out for us and why this subject came up in meetings that you were attending?
Yeah, absolutely. So we held a prospect presentation last week, or earlier this week, I should say. Excuse me. And one of the subject matters that was brought up was the notion of financial planning for young adults, and this was brought to me by one of my clients. His girlfriend suggested it, and I think it comes from a place of probably personal experience, but also thinking about her fellow colleagues who also lack the knowledge and perspective that comes with being somebody who's just getting into your career. You're just coming out of school. You don't really have a lot of ideas. If you're not in that program, like if you don't go into some sort of business or financial program, then you don't really have a lot of knowledge as to what you should be doing, what's the appropriate way that you should be constructing your financial affairs. But unfortunately, a lot of times, because of the size of the assets that those individuals have, they kind of fall through the cracks in terms of service in the financial industry. So she suggested to me, she gave me a number of different topics, which I'm hoping to address today, and just to kind of give some perspective as to what we think is appropriate, what we would recommend to people in that situation, and just give some background knowledge as well, so that they can have a better idea as to how they should be managing their financial affairs.
Well, no, I look forward to it. I work with a lot of financial advisors, and the idea of financial planning, of course, is exactly what they're comfortable with, and the language that they speak, right? What intrigues me, though, is the young adult part of this, because I get a sense from most people I talk with, people don't really walk in when they're young and they're starting out. They go, well, we're in our mid 40s now. We've accumulated some money, so we should have that conversation. But it sounds to me like you're talking about having that conversation earlier and getting planning going earlier. Am I correct?
Yes, absolutely, you're correct, and it's important to get those things started. So I'll touch on a really short one first, and then we'll get into what you just described there, which is when is the appropriate time to get started. But the first question she actually approached me with was, how do you take care of burial costs when you have a family member pass away? And that's for somebody who's gone through it, it seems like a very easy answer. But if you've never been in that situation, or you've had to figure it out, it's a very honest and very real question that a lot of people probably have. And the answer to which is usually that you have a life insurance policy that pays out upon death. And that life insurance policy is what the family and the estate uses to provide liquidity to cover all the short-term costs that are incurred with, burial, funeral arrangements, of what have you, while the estate is going through the estate settlement process. Here in Canada, we have what is called probate, where it goes through a process. We've covered it in one of our previous podcasts, but I'll just quickly recap that. For a 1.5% fee, the courts validate the will and make sure that it is in fact the true and testament and will of the individual who is deceased. And so while that process plays out, it can take up to a year for that process to play out. There's a need to actually have financial liquidity in order to pay bills, in order to, like I said, cover funeral arrangements, and that's where that comes from. And as a result, a lot of people don't have that perspective if you've never gone through it. So I think one of the things that I would recommend, and that we would recommend, is it's important that children are included in the estate planning process for the family. So, adult children should be, they don't necessarily have to be kept abreast of every single detail that goes into the estate planning, whether that's, how much they're going to be left in terms of financial assets, but they should have a general idea as to what the parents' will is, or not will as in the written will, or what their desire is, and what they would like to have as the final arrangements for them upon death. And so that way that there are fewer surprises when the event actually plays out. Because as you know, Bill, and as everybody probably knows, when an event like that occurs, you are already dealing with so much emotional upheaval, so many distractions happening at the same time, whether that's, trying to make arrangements, whether that's people reaching out to you to express their condolences. There's a lot of things that are coming at you all at once. So if you have a better handle on what to expect in advance, it just takes a little bit of that stress off of you when the event actually occurs.
Makes total sense. So where do we start?
Where do we start is we start at the beginning, because that's the best place to start.
It usually is.
The biggest question that, she asked, or one of the biggest questions that she asked, and she says, a lot of people ask is, when should I start investing? And the answer to that is as soon as possible. A lot of people, they think, well, I don't make a lot of money. It doesn't really make sense that I should be investing. Nothing could be further from the truth. Even if you have a little bit, and no matter how small it is, you should be setting that aside, because you have a finite number of years in which you have earning capacity. There's only so long that you have the ability to earn, whether that's because you physically are not able to, mentally aren't able to, or employers, if you're not a self-employed individual, will not employ you beyond a certain age. And so you have to make sure that you maximize those revenue generating years in terms of setting aside assets that will sustain you in retirement. And the compound growth over that period of time is invaluable.
Oh, man.
I've talked about this before, but my dad did an exercise with my brother and I when we were younger. I think I've told the story on the podcast where he gave us each a scenario. He said, I'm going to, like me, Alexander is going to invest, not right away. I'm going to wait, 5 years and then start investing, but I'll invest twice as much in order to try and catch up. Whereas my brother invested a smaller amount, but for a longer period of time, and he ended up with more money because of the fact that he had the benefit of compound growth over that period of time. I don't remember the exact numbers, but it was significant that the fact that even though I was saving more at a later point in time, the fact that he started earlier benefited him in the long run. And I think that's a key lesson for people to take away, is that you should be starting as soon as possible.
Yeah, no. And I just want to add a note on compound growth, because it's often quoted, it's often cited, but it's the truth. Albert Einstein considered compounding the eighth wonder of the world, because it makes a dramatic difference. So how much should you aim to save?
That is an answer that is very subjective. Depends on everybody's circumstances. But what we recommend is that individuals save at least 20% of their after-tax income. If you can't do that, obviously you can't encroach upon your fixed expenses. You need food, you need shelter. There's certain necessities that you're going to have in your financial profile in terms of expenses that you cannot do without. And so without encroaching upon those items, as long as you're able to save something beyond those expenses, we would recommend that. At a minimum, we hope to try and encourage people to get to 20%. And then the other thing that they should try and keep in mind is that you might want to maintain a cash balance equivalent to 3 to 6 months of expenses at a minimum, in the event that you lose your job unexpectedly or your pay dramatically changes for a short period of time.
I would add something to that, and that is something that is difficult for some people to achieve. But when you're young, the best opportunity to save is when you just finish school. And if you can bring yourself to staying with your parents for 2 to 5 years, it really allows you to build a substantial base to buy your first home, or at least to get you on a better footing financially, and to invest in a fashion that's going to allow for growth. And that's something that many people don't want to do because they don't want to live with their parents any longer, or they can't do whatever. But if you can manage that would be a huge head start. And if you can't do it with your parents, do it with a roommate, do it with a cousin, do it with someone that you think you can get along with, and share expenses. And that really makes a big difference.
Yeah.
Especially as we know, and this is true on both sides of the border, that there's an affordability crisis when it comes to housing. It's very challenging for young adults to accumulate enough assets to be able to live on their own. And my dad's absolutely right. I remember actually my friend Sheldon told me this when I was younger. He said, live at home as long as you can. And I remember thinking, I get that. But, at some point I want to have my own home, and I want to have my own space and whatnot. And it's more of a I think in a lot of times it's more of a competitive thing. At least it was for me to say, I've reached this milestone. That's, it's another checklist item that I've achieved. But having lived on my own now for a few years, and seeing everything that goes into home ownership, I totally understand where he was coming from, and I give people the same advice now, and that's, try and stay home as long as you can, because it's expensive. It's really hard to save. Once you get on your own and you have all these expenses, not only the fixed expenses, but stuff that unexpectedly comes up. It was so much easier to save when I was first out of university and working my first job at CI Investments. I remember at the time thinking, oh man, I'm not really saving a whole lot of money, but because I wasn't making a ton of money at the time. But and when I look at it now, I think, holy cow, I had so much, money that was basically just getting parked away, and I was barely spending anything, and it was great. Like,
it's better to sacrifice and live a little bit longer at home with your parents when you're 20 odd years old than to be forced financially into a situation where you have to come back at 35 or 40 because you could no longer afford to be on your own. And that is far more uncomfortable. If you think it's uncomfortable staying with your parents in your 20s, think again how uncomfortable it's going to be if you have to come back when you're 35 or 40. Not good at all.
No, I understand. But, my kids did the same thing. When they graduated from college, they came back, and each of them at different times stayed here for a year and were working, and they were able to save money, and they were able to get themselves steady, and they were able to provide themselves some cushion, as it were, before they then went out and lived on their own. And yeah, they definitely were like, we really want our own place, and completely understandable. And I applauded it, as I'm sure John applauded you, Alex. We're like, good. At some point you need to leave. But yes, no, I totally understand the point you're making.
Listen, Bill, like we actually had a, going back to my dad's point about somebody having to move back, and one of my friends, his brother had to move back home after a period of time where he was living on his own, and he had this grand idea about living on his own, and he was going to have his freedom. He didn't want to have to live under the thumb of his parents anymore, and he was barely making enough money to get by on a monthly basis, and so he ended up having to move back home. And unfortunately for him, he's not very good at managing his resources, and so now that he's living at home, his parents have actually forced him to pay a certain amount of rent, and it's not to punish him.
It's not punitive.
They're taking that money. They're basically setting it aside and investing it for him, so that when, if he ever gets to the point where he has enough money to move out, they can actually give it back, the money that he's been paying them as rent, and help him get started with his next home whenever that event happens. And so that's another tool or suggestion that parents can take if they're in a situation where an adult child has to move back home with them. They can go and they can, ask them to, just as basically a forced savings mechanism, ask them to contribute to some of the expenses around the house, take that money, set it aside for them, and then, you can give that back to them upon, them moving out in the future.
No, it makes total sense. Total sense. So let's get into some of the pitfalls of young investors as we're moving forward here. What do you counsel the folks you talk to?
I think one of the big pitfalls is, I mean, number one, the young investors all think they have tons of time, and to a certain extent they do. They see this giant horizon in front of them, and they think retirement. I'm 20 something years old. Retirement's 40 years away. What the hell do I care about that? And so what ends up happening is the focus of their behavior and of their spending becomes on current consumption rather than setting money aside, because they think, I don't need to worry about retirement. That's not really relevant to me. I'm not anywhere close to retirement, so it doesn't matter. And so the temptation becomes to spend whatever money you make. I used to see it when I worked at CI. There were some people who were great at setting money aside, and there were, guys who and ladies who went out and spent a lot of money on during the week and on the weekends. And I used to think to myself, how the heck can you afford to do that? I was maybe I was too frugal with my spending, but I used to look at them and think, my goodness, like every single night or every Thursday, Friday, Saturday, they're going to the bar and they're drinking and running up tabs that are in the hundreds, if not thousands of dollars.
No. We know what that's called. It's called peer pressure, right? Because your friends are doing it, and you're thinking, my friends are doing it, and hey, I'm only young once, and these people are having a good time, so why shouldn't I?
Oh, and the one I hear a lot is, well, I want to have these experiences. I want to have that experience now while I'm young. I don't want to have it while I'm older, and that's great. But you also there's got to be a bit of give and take here. Like, I understand you want to have some experiences,
Yeah, sure.
go for it. But that doesn't mean that you need to go on bender after bender of spending, and that doesn't necessarily mean an alcohol consumption bender. A spending bender where it's I'm going to travel to Thailand, and then I'm going to come back and I'm going to travel to Hawaii, and then I also want to go and I want to have a Europe trip, and I want to do all these things. I want to experience all these things now while I'm young, and great, you want to experience them while you're young, but maybe choose one or two, or do one a year, and then still make sure you're setting aside money because of what we talked about, which is the value of that compound growth over time. That money needs time to grow, and so every year that you kick the can down the road, that increases the amount that you're going to have to contribute in the future in order to make up for that missed compound earnings. So that's number one in terms of the things that I see. Number two, I see a lot of people who say, well, I have a pension, and so it doesn't really matter. I can just spend everything I make, and I don't need to set any money aside outside of my pension. And for a lot of people historically, that may have gotten they may have gotten by on that. And my dad's covered it a lot of times in our presentations when it you talk about somebody who gets the golden handshake, you get your watch, and then you go home, retire, and the man passes away within 5 years from a heart attack, and the woman passes away about 5 years after him, and after 10 years the pension cost is gone, and they don't have to worry about it anymore. The problem now is that we're living too long, and that's not a bad thing. You want people to live a long time, that's great, but the biggest risk that people face is longevity risk. And so the longer you live, although you're still going to have your pension, assuming you have a fixed pension, and I'm thinking about people who are teachers, police officers, public servants. Essentially, it's the only people who really get pensions anymore.
But those groups that you mentioned are about the only people in the United States that do have a fixed pension now.
Well, the truth is the scenario that Alexander was just painting was from the 1960s and 70s, when people would work for the same organization for the entirety of their career and get their fixed pension after they retired. But we all know today, in a globally competitive economy, first of all, all private sector corporations have turned over the responsibility of wealth accumulation to their employees. And all they do is facilitate a savings vehicle. In Canada, the group RSP, in the States, a 401k or an IRA. And here's the menu of investment options. You choose what you want. We'll match you, but we're not going to promise you what you're going to have at retirement. It's whatever your money grows to. Whereas in the scenario Alexander was discussing, it was a defined benefit plan. And as you both have noted, that's a public sector pension only these days. And the private sector, that's a dinosaur. That doesn't exist anymore. So it's really incumbent upon the individual to be proactive and be disciplined to make sure they save regularly.
Yeah, and the thing that the reason why I was bringing up the whole notion of longevity risk is because if you're living a lot longer than people have been in the past, there's greater opportunity for you to incur expenses that you didn't necessarily expect. And therefore, your retirement may be more expensive than you expect, and the income that you're generating from your pension may not be enough. A lot of times the pension is 70 to 80% of your earnings during your peak earning years, and so that's the income that you're going to get into perpetuity until you die. And that's great, except what happens if your expenses in retirement are greater than 70 or 80% of what you were earning when you were working?
Most people don't anticipate the extraordinary cost of healthcare in the final 5 years of their life. And it doesn't matter whether you're in Canada or the US, even here in Canada, if you require care ongoing care. You're either going to be in an institution that costs you from $6,000 to $9,000 per month, or you're going to need in-home care that it might cost you a little bit less, but you're not getting 24/7 coverage. And if you want 24/7 coverage and you want to do it at home, well, that's going to be probably twice as much as it would be in an institution.
Yeah. I was speaking with somebody recently at one of at a friend's child's birthday party, and he was telling me, well, my advisor was saying, don't worry about it, just spend all your money, and if you need to go into a home, then you can rely on the public system. And I thought, that's horrible advice. First of all, we don't know, and then this is true for not just Canada but anywhere. You don't know what the future is going to hold. You don't know what changes might come in terms of the healthcare system. To sit there and just say, I'm going to rely on the public system to take care of me, it's the public's responsibility to look after me, is naive and, in my opinion, misguided notion.
That advisor should lose their license to practice, because that is completely irrational to make such a suggestion.
Well, yeah, and that does actually bring up a question, guys, because when you're young, like your friend Alex, you don't have a lot of assets. You probably don't have access to a lot of good advice, which is which I think your friend is lacking access to, as a matter of fact, and I agree with John.
Yeah.
So what advice can you give folks in those situations?
Yeah, I think it's, as you've correctly pointed out, Bill, it's challenging, because when you don't have a lot of assets, look, and I speak, on behalf of advisors in our position, or portfolio managers in our position, we have a fixed amount of time that we have available to work with clients. All right. And that's not to be condescending or anything, but, in order for us to provide good service, you can't have, 500,000 clients, because there's not enough time to be able to give them all good service, to give them the attention that they need. And so with that being the case, you have to create some sort of cutoff, some sort of, minimum threshold, in order to say, in order for me to give the type of service that I think is important and what my clients deserve, I need to only be working with, people of a certain asset size. So that way I don't end up with 5 million clients. The banks and the other large institutions, they take any and everyone, but the service that they provide is garbage, quite frankly. They don't care about providing good quality service. They're just looking for volume. And so when you're in a volume-based business, that's fine. You can say, I'll take on any and everyone. But when you're in a service-based business and you want to provide high-quality service, you can't do that. And so one of the things that I would suggest to people is that you're better off if you can try and household your assets. And by that, I mean group your assets together with other family members, so that when you approach somebody who is an asset manager, who's a high quality individual that warrants working with, you can do that, and you can go to them as part of a household and say, look, I would like you to handle my money as well, instead of them looking at you individually and saying, oh, you only have $40,000, it's not really worth my time to manage your money. They're going to look at it as, oh, well, it's $40,000 for this person, but they also come with, 3 other members of their family who collectively have, $1.5 million in assets. Well, that's all of a sudden a much different proposition. And it makes sense to take on that person as a component of that larger household. And so the best thing that you can do is you can try and latch on with your family member, so that way you're dealing with somebody who's reputable, who knows what they're doing, who can give you good advice and give you good service. And you don't get stuck in a situation where your only options are the discount brokerages or the banks or other major institutions, where you're not going to get good service. A lot of times they try and manipulate your behavior with fees. I just saw this recently with the bank that I deal with here in Canada. They were saying to me, well, if you open up a small investment account, we'll cut your banking fees. And I was pissed off with them. I said, I shouldn't be paying any banking fees. You take my money, you lend it out, and you charge interest on it. Why the F am I paying whatever fixed amount per month for you to manage my account? Like, get bent. Anyway, that's a separate tirade that I can go on. But the point was, they said to me, well, if you open up an investment account, small investment account with us, we'll waive those fees. And so what they try and do is they try and entice you with a nominal charge to them. It's whatever, $7 a month, $10 a month. It means nothing to them. But the fact that they will then get you to take your money and invest it with them, and then it's like a drug dealer. Once they get you hooked, then they kind of reel you in more. Like, wouldn't it be easier if you just had all your money here with us, and you get your mortgage here too? All you got to do is you got to sign into one place, and everything's there for you. Isn't that great? And they rely on the fact that people, I don't want to say are lazy, because that's a bit of a negative connotation. But
no, it's true. They are lazy.
They are lazy.
People are lazy. Let's face it.
I'm trying to be diplomatic about this.
But just to interject a little perspective, I mean, if you're
people are busy.
Yeah, there we go. People are busy, so they don't, and they also, and I saw this from years from being a business and financial reporter. A lot of people don't understand.
Mm-hmm.
A lot of people are not inclined like you and John. They don't understand. They're like, look, can I go to somebody and sit down with somebody and say, look, this is what I have. What can you do with it? And can you kind of keep me posted on what's going on,
Yeah.
And it's not as much laziness as it is that they just don't know what to do.
And a lack of perspective to be able to say that, whatever I'm getting here is not great. They don't know any better. They know what they're being told by the bank or the institution. And so as a result, if they whoever they're dealing with tells them everything's great, then they think everything is fine. Actually, going back to that presentation on Tuesday, lady came up to me. She goes, I love the way you guys provided a unique perspective. She said, I never thought to look at it that way. I thought what I had was just fine. Now I'm looking at it and thinking, oh my God, this is garbage. Why am I wasting my time with the, I think she's with the bank right now. And she goes, why am I wasting my time with the bank? I'm not getting anything. I just assumed this was all I could expect. And so you're right, Bill. They don't have that perspective. And even if they do, a lot of times it's the inconvenience of having to make the change that people just say, you know what, I can't be bothered. And that's what those institutions rely on, is people who either don't know or just can't be bothered to go through with the effort of making a change, even though it's not really that great of an effort. It's just one more thing for them to put on their plate, and they just say, you know what, that's fine. Just leave it there. It's good enough. And one of the things that really, it bothers me to no end, I don't generally get bothered by commercials. The Wealthsimple commercials, you wouldn't have seen them. They're up here in Canada. I'm sure there's probably something similar in the United States. It's a discount brokerage firm, or Questrates are, not Wealthsimple. Where they try and tell people you shouldn't be paying fees. Fees are evil, and you can do everything yourself. For people who have the knowledge to do it, great. If you don't know what you're doing, it's not that great. But anyway, that's a separate conversation.
Even if you know what you're doing, you don't have the emotional detachment to make good choices.
No, that's true. That's a good point. But anyway, the commercial that bothers me is a Scotiabank commercial. And so Scotiabank has this commercial where there's a guy who's having dinner. He's waiting at a restaurant for somebody to join him, and he's sitting at the table by himself, and he looks outside, and he looks across the street, and he sees somebody up in an office he sees somebody first in a limo. And the guy in the limo, as he's driving by, looks up and sees somebody in an office, one of those big, tall office towers, and working hard late at night. And the person in the office tower is looking at somebody who's flying by in a private jet, and the person in the private jet looks on the ground and sees somebody who's getting out of a private helicopter. And anyway, you get to the end of the commercial, and the premise is there's always more and more. You should just be happy with what you have. And it's basically conditioning. Like the bank is conditioning you to basically say, you know what, you could probably do better, but it's fine. You should just be happy with what you have. Don't ask for any better. Don't expect any different. And just, ride it out, wait till you die, and that's life.
Stick with the horse and buggy. Don't worry about the fact that people have moved on to cars.
Airplanes or moving into space, Elon Musk, who cares? SpaceX, whatever. It's horse and buggy. It's great. We know it. It's reliable.
Set your sights high. I mean, basically what you're saying is that you don't necessarily settle. Set your sights high.
You should always be aspirational.
Amen.
In all areas of your life, but especially on financial matters, you need to be aspirational, because life is very competitive and difficult and expensive. And if you're not aspirational with your investment and financial planning, then you're going to fall behind.
Yeah. Well, on that topic, guys, I don't this may not be an appropriate question for your audience in Canada, but I know that in the States, a lot of young people are looking at massive amounts of debt when they get out of college. And I don't know what the situation is there. Maybe it doesn't hold true in Canada. I mean, but it's a reality that has to be dealt with.
It is true here, or maybe not to the same extent that it exists in the United States, but one of the issues that we've talked about on this podcast before, and we've talked about in other situations, is the fact that the bachelor's degree at this point in time is not really worth much. It is more of a filtering mechanism, and it is so prevalent in our society. The value has been watered down to such a degree that people are forced in many situations here in Canada to have to get a post-secondary degree or some other sort of credential in order to differentiate themselves when it comes to hiring. And so as a result, whenever you're talking about graduate education, that can be incredibly expensive. I did my master's degree, and that cost me $100,000. So it's not an insignificant amount of money that you're going to have to fork over and pay back over a period of time. And so it is a big issue. It is something that is becoming more prevalent in society. And so investing is a great way to try and help manage the cost of that burden. As long as your rate of return is greater than the interest that you're paying on your debt, you're able to service two different purposes simultaneously. You're still setting money aside for your future, and you're also able to pay down your debt. And so it's a great tool, and a tool that everybody should be taking advantage of is, taking some money, setting it aside, and then investing it, and then using the proceeds of that investment to help offset some of their debt. Dad, do you have anything that you'd like to add on that?
Yeah, tax the foundations of the Ivy League universities, and they can pay off the debt of their students instead of making students pay for it. And they should have programs that have meaningful potential for employment rather than these fuzzy things that are involved in political and social issues. We need more engineers, and we need. This is a separate subject of conversation.
It's a totally separate subject of conversation, but it's really interesting. After that is actually, John, the origin of the land grant universities in the United States following Civil War. Here, Abraham Lincoln decided that we, as a nation, there were certain professions that we were needed in. And they established these universities. And if you were going to be an engineer, for example, you could go to, there's a university near me, Lehigh University, and you could go tuition free because we were going to need engineers to rebuild. So yes, that's an entirely separate conversation. But
I think Alexander covered the point well. It's not there's no easy answer to this.
Right.
And we can say you should, but there's no easy answer to this. Paying off your debt, if you're a student, if you're in the U.S., you want to amortize it over the longest time frame possible. And if you can't do it through conventional means, go find unconventional means and amortize it as long as possible to relieve yourself of the burden. And periodically, if interest rates come down, you can refinance it at much lower rates. So that's something that can be done on both sides of the border if you have a substantial debt. But why get into it? You really, when my generation came up, there was an opportunity. I remember my first year economics class, the professor talked about opportunity cost. And he said, there's a question as to whether or not you should even be in university because the opportunity cost is so high. And he said, you're going to pay this amount for the next 4 years. And meanwhile, someone who's in the workforce already is already earning X amount of dollars. By the time you're done, you're in debt this much. This person has already saved this amount. And so is it worth your while? Now, I would say, and I never at that time, I didn't even consider that at all, because being the child of immigrants, the only way out for me out of our place in society, out of poverty essentially, was to get a good education. So there was no hesitation in my mind. I'm going to university, I'm going to graduate, and I'm going to find a great job or become self-employed. And that was the only route I knew to get out of our financial situation. But today, as Alexander pointed out, undergraduate degrees, for a variety of reasons, are not as valuable as they used to be. And I think people need to take a much closer and harder look at post-secondary education and say, okay, I'm going to spend all this money to go to this university and get this degree in this area of study. Is this going to actually pay me anything? And there are a lot of degree programs that have no market value or very, very limited market value. So you go and you study social studies, and you spend whatever $40,000 to $80,000, maybe more in the U.S., and you come out and you're going to get an income of $25,000 a year. Well, what's the point? You know, there's a shortage of trades on both sides of the border, and people should be looking much closer at, can I learn a trade? Can I start my own business? Can I perhaps look at hard subjects like engineering, science, medicine, business, and go that route instead of these other soft subject areas like sociology and history and English and all those things, which are all, nice and interesting, but
they're all nice and interesting. And we could, we're about to walk down a path taking us into a whole nother podcast, which no doubt would be extraordinarily interesting and somewhat, controversial with some people, as a matter of fact. But let's finish up this one. Let's finish up this podcast in terms of, young adults who, Alex, I would put to you, the people who came to you and asking these questions were really and truly at the beginning because they were conscious. They knew enough to come to you and say, hey, how do I answer these questions? How do I do this? Which I think speaks well of them, actually.
It does. It's tremendous to have that level of awareness and the courage to seek out that information and seek out that assistance.
I'm not so sure they were conscious. I was speaking. I'm surprised that they were awake.
Oh, she looked like she was fading fast during the presentation, but it was a way
it's
to keep her
It's possible she was
upright.
Sleepwalking. Okay.
One thing I did want to just circle back on, Bill, is going back to the notion when we were talking about being left to the institutions or the discount brokerages. One of the things that, and my dad kind of briefly touched upon it. One of the other issues that people who say I'll just do it myself is they lack the perspective that we have as people who have studied the markets extensively, and in my dad's case have decades of experience in watching what has happened. And as a result, when you don't have that perspective, you can often get yourself into trouble because you become manic depressive. You ride the highs really high, and then you ride the lows really low, and you end up making bad decisions, panic decisions. We've talked about at length on this podcast behavioral biases and how they can impact our decision-making process. And, having that lack of experience and that lack of perspective can really set people up for failure. So going back to what you were saying about our attendee from the presentation, she had great perspective and great courage to say, you know what, this is not my area of expertise. This is not my forte. I'm going to seek out people who know how to manage this for me.
Exactly.
And work with them.
And that is great. That is great because that is the beginning.
And if you're hyped up on Doritos and other simple carbohydrates, your manic depressive behavior is going to get even worse.
Let's just throw one more log on the fire there. Like, why not? Do you want to crap on Ritalin and the pharmaceutical industry too while we're at it?
I no longer own Pepsi.
Oh my gosh. Let's just grab some gasoline.
Thank God you got that disclaimer in, John, for crying out loud. Oh, God. Well, so guys, as we wrap this up, you got any, just a couple of really simple pieces of advice to folks who might be listening to this podcast thinking, well, what do I do or what's next?
My advice would be start soon, save as much as you can, talk to an expert.
I think that's valuable. My piece is get off the Doritos addiction and have real food.
Who knew that you had RFK Jr. as your podcast partner?
Let's make North America healthy again.
Make North America healthy again. Oh gosh, as we leave, what is the best way, John, Alex, for people who are listening to this podcast who want to reach out and maybe learn a little more about what you do? What's the best way for them to contact you?
They can send us an email at info@medwealth.ca. That's info@med-wealth.ca. And I promise I will not respond with a comment about Doritos.
And I do love a good Dorito, but rarely. I just very, very rarely. Okay.
Bet you can't have only one.
That's Lay's.
Well, unfortunately,
That's Mark
they're
Messier.
the same company. Yeah, the same company, and I can't just have only one. So
It doesn't matter whether it's Lay's or Doritos. It all works. The food scientists have figured out a way to stop you from having only one.
all of that stuff, if you eat too much of it, will definitely, absolutely, positively be your undoing. That is the truth. Because, John, we're all headed toward the death door at some point. Anyway, no matter how well we eat.
Okay,
So.
let's end on that optimistic note. No, we need. Okay, so I'm an optimist. I've always been an optimist, and we need to always be aspirational in our behavior. It's too easy to give up. It's too easy to tread water. You need to always be moving forward. And as a young person, the most important thing you can remember is that although you have your entire life in front of you, the earlier you begin, the sooner you can accumulate the sufficient assets to have your financial independence. And you need the guidance, as Alexander pointed out, because left to your own devices, you're not going to have the personal discipline to do the tough things like save and invest and avoid market machinations. So all good advice. Start early, invest wisely, get professional help.
And be aspirational. I like that note. And that's a perfect one to end on for this podcast. For those of you who are listening to this podcast and are not subscribers, I don't know how you can't be after listening to this episode. All you have to do for that is just hit the follow button. Then you're a subscriber, and every time John and Alex drop a new episode of the podcast, you're notified, and you can listen to that one as well. The other thing I would ask is that, if you like this podcast, you find it funny, amusing, informative, helpful, tell people about it. Word of mouth promotion is very welcome, and we would very much appreciate it. Until next time, I'm Bill Tucker on behalf of John, Alex, and everybody at MedWealth Financial. Thank you so much for listening. And remember, you can go out today and make it a great day or not. The choice is yours. Until next time.
Thank you for listening to Prescribing Prosperity. Visit our website at med-wealth.ca. That's med-wealth.ca for more information or to connect with us for a consultation. Don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the hosts and their guests and does not necessarily represent the views or opinions of IPC Securities Corporation. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investment advice. Always seek the advice of a qualified and licensed financial service provider with any questions you may have regarding your investment or retirement planning. MedWealth Financial Services can provide a private consultation to help you determine the suitability of any guidance discussed on the show.